Hello everyone, welcome back to the channel. It has been an absolute hot minute since the last time I released a video. My recording computer was down for a prolonged, much longer period of time than I originally anticipated. Today we are going to be discussing infinite banking, whole life, corporately owned policies, and seeing, I guess, the differences really in how these things are structured and how you can ultimately access these things. Now, before we begin, especially in this episode, certainly in all of them, but more so in this episode, it's very important to understand that I am not a financial advisor. I am not an insurance agent. I am not an accountant. I'm going to be discussing a lot of topics based on my conversations with financial advisors, with insurance agents, with an accountant. So you should seek the advice of your own professionals prior to implementing this, because if something goes wrong, you need to understand you need to make sure that you understand the rules, laws, regulations in your area. So without further ado, what we're going to do is talk about infinite banking and corporately owned policies. So the first thing that we need to do is first understand how things typically work. Now, if we're talking about corporately owned policies, that means that somebody is running a business. So let's talk about traditionally how somebody would use and manage their money personally when they run a business. That is incorporated. We're gonna stick with incorporated companies, and so typically speaking, how this would end up working for most businesses is you would have an operating company. We're going to call it an opco that would generate revenue, and this revenue here would get moved over to a holding company, which we're going to call a holdco. This is typically where individuals would park money. But it's typically used as a liability protection thing because the opcos would actually provide services to the customer. And so if the customer is going to sue somebody, they're going to sue the operating company, which makes it difficult for them to know who this holdco company is, or at least attack the funds. So they use this primarily to park money. But I would suspect by and large, a lot of people move this money very quickly over to themselves. So we're going to call this the personal. And then ultimately, they go ahead and use these dollars that come personally and use it to spend and invest with. So this is typically kind of how things work. A lot of people will invest in their holdco, but most business owners, they don't really keep a tremendous amount of cash there. Now, when you look at the taxation standpoint, the way this ends up working is the operating company pays tax. Your holding company is, at least in Canada, is typically eligible to receive the funds tax free. And then when you move money from the holdco over to the personal side, you get taxed again. So you actually get taxed twice. But it's for that reason that there's preferential tax treatment of dividends and stuff like that. How this ends up working and how corporately owned whole life policies work is you would have, again, your operating company, your opco, which again would generate revenue, which would then go in your holding company. Now, the holding company would go and get a whole life policy. And so this money would actually flow into this whole life policy, and naturally, any excess money could continue to flow out personally, and naturally be spent on savings/investments. So here's where the big question becomes: okay, well, how do you, the person, access the money? What is the benefits? What are the differences? What's the cost perspective, et cetera, et cetera. So I figured in this video I'd be answering three primary questions. So the first one is, give me a second, I'm going to try to find a place to put this. All right, so we're going to be talking about the costs, accessing the funds, and the protection and the differences that come there. So from a cost perspective, remember that the money gets taxed twice for dollars that are earned inside of the corporation. First, they get taxed with corporate tax. The money that's in the holdco typically gets transferred tax free, and then you get taxed on personal income taxes. So how this ends up working when you have a whole life policy is the money gets taxed in the operating company. However, the money that gets it put into the hold company is, well, I don't want to say tax free. It's just not taxed again. And so you're actually able to buy more with your dollars. So let's pretend you've got $100,000 of excess revenue. You pay, I don't know, 15% tax, so $85,000. is what you'd have left over here. This money would move over to your holding company. So you'd now have $85,000. In theory, you go and dump $85,000 into your whole life policy. But if you didn't and you moved it over to your personal side by way of, say, a dividend, it would get taxed again at whatever your tax rate would be. And I'm not going to be doing math for this video. So we're just going to say 85,000 minus, I don't know, 25%. I'm making numbers up, right? So you end up being able to use a lot more money to fund policies and create more wealth and grow money faster. Now, most people, when they do this, they're very intrigued at accessing the funds. So the costs, before I move on too quickly here, it is cheaper or less expensive, or you can put more money into the whole life policy with the same amount of dollars for a corporately owned policy than you otherwise would be able to personally, because the money that you deposit into your policy on the personal side is net of taxes, whereas the money that you put in the whole life for a corporately owned policy would not be net of personal taxes. Okay. So accessing the funds, this one we're going to have to bring our little window over here. So accessing the funds is a little different with a corporately owned whole life. So we're going to need to take a little journey down corporate taxation and how taxation works. Okay. So you've got your whole company and you've got your personal situation. So there's essentially, I don't know, I'm going to say three, two main ways, three main ways. We'll say three main ways of taking money out of a holdco traditionally. Okay. So the first one is going to be a wage. The second one is going to end up being a dividend. And the third is going to be a shareholder's loan. Okay, shareholder's loan. So wage moves over and it just gets taxed on normal amounts. I can't think of anybody operating a hold company that would be paying a wage out of their holding company. Typically they would be paying a wage out of their operating company. I'm not even sure you can pay a wage out of a holding company. So if any accountants are out there, let me know. But the way this ends up working is this acts as an expense over here, and this acts as, getting fully taxed. Fully taxed. This is from a holding company. Very rare, if not impossible. Remember what I said earlier. So don't do this. Consult with your financial professional first. The way the dividend works is you dividend it out. You get taxed immediately. Well, and you know what? I'm going to actually erase this up here. That's what we're going to say. The taxes that you end up paying, you get taxed immediately. Get taxed immediately. On a shareholder's loan, you get the money, quote unquote, tax free. However, if you do not pay the shareholder's loan back within a 2-year window, you end up getting taxed on the entire amount, whether it's dividend income or otherwise. So, really, what ends up happening when you move money from your holding company to your personal side, you end up having a pile of taxes that end up accruing. So, this is where the whole life policy ends up being quite interesting. So, how this ends up working is the money is in a whole life. So let's just use our example, $100,000. Okay. And if you were to go ahead and the corporation were to take a policy loan out and then move the money over personally, it would be either taxed immediately or within 2 years, depending on how you move the money out. And so you need to be cautious of this. What you end up doing, what you can do, is you have your whole life policy. I'm making a mess here on the screen. You can actually go personally, take out a line of credit that is that uses the whole life as collateral. Okay. And then withdraw or take loans out from this line of credit, which are completely tax-free. Now, this is where people get a little, I guess, start asking questions. Well, what about the government? What about, somebody's got to be getting their money somewhere. So this is where it gets confusing. This is where you got to really talk to an accountant. So my understanding is, as long as you personally pay a fee to your corporation, the holding company, for allowing for the corporation allowing you to use the whole life policy as collateral for your line of credit, typically to the amount of a payment of 1% of the borrowed amount, okay, per year, there will be no tax consequences, and CRA is completely fine with this setup. Now, you have to realize, paying a 1% fee compared to, anywhere from, say, 15 to 30+% taxable rate compared to dividends is a significant amount of savings. When you factor in that you've brought money in from your operating company that's only been taxed once and not twice as in your personal side, and the fact that you only have to pay a nominal fee on a yearly basis for the amount you've borrowed, not the whole life policy as a whole, this becomes an astronomically powerful tool. And in theory, you can almost do this with anything. You can have an operating company that has a holding company, and you can have another, real estate investing company if you want to get some, very specific, have a line of credit in there that pays a fee over here. So you can spread this and kind of make it so that almost all of your institutions can access this money on a very, very low cost base, right? But most people, they're more interested in pulling money out personally. And so, yeah, you're totally able to do that. So I'm sure this is going to stem a lot of conversation in the comments. So I do await for the comments. It's going to be great. I don't claim to be an expert on this. I do not do this currently. I do not have corporately owned policies. So I may be overthinking or overanalyzing or just flat out wrong. And if I am, let me know. I like the conversation. It's fantastic. And if you're interested in doing this, I do recommend that you first speak with an accountant, because this type of stuff is very, very complicating. And the last thing that you want is the government to come down and say that what you're doing is essentially tax evasion. So without further ado, I will catch you in the next video. Thank you. Bye.